In this video, you'll be learning about this topic.
So in 1972, Buffett, in large part Charlie Munger's influence, started to pivot away from buying what he calls fair companies at a wonderful price to buying wonderful companies at a fair price, mostly exemplified by his purchase of See's Candy. And this brings up the topic of quality investments, which you also wrote the book on. And I find quality to be an elusive muse, right? I'm reminded of one of my favorite books, Zen and the Art of Motorcycle Maintenance, in which the protagonist goes on a motorcycle journey across America solely as a means of discovering the definition of quality. And just a side note, I just cracked open your book this week and I saw this exact analogy on the first page. I just thought it was so funny that we were just really quickly aligned on that. And so through this book, you've achieved a definition of your own, right? When it comes to what makes a quality investment. So can you describe to our audience how you define quality and how much it factors into your own investment philosophy?
Yeah, thanks, Trey. I think what quality investing is wonderful companies at a slightly high price, at a fair plus. It's okay to pay up for quality. If you're going to buy a significant position in a high-grade company that you expect to be around for a long time, you expect to hold for a long time, and it has quality attributes that I can get into, paying a little extra for that is reasonable. If you're right and your analysis backs the conclusion that this company will generate high returns on invested capital for the foreseeable future, 3, 6, 9 plus years, if it's trading at a little bit of a premium, don't worry about that. And so it's the opposite of deep value. It's the opposite of what Ben Graham did. And it may be a little more generous than what Charlie recommended Warren be willing to do in the See's Candy pivot. And so by quality, look, that's a realistic appraisal of the current environment. There's just, and I don't mean just sitting here now in December of 2020, but for the last 10 years or 20, it's extremely hard to find those Ben Graham value opportunities or even the Warren Buffett value opportunities. It's just in the public capital market. But if you sit down, what we did in that book is describe an approach to identifying what we call quality companies and making quality investments. And we start with microeconomic analytical analysis about industry structure and barriers to entry, economies of scale, rationality among competitors, and then looking at particular companies to discern their moats, their competitive advantages, what structural protections they have against invasive rivals and technological disruption. And so we give the obvious examples are things like brand strength and network effects. And we give some other more subtle examples, such as having a friendly middleman. That is, so you're selling eyeglasses, let's say, through optometrists to patients. And if you are able to enlist a loyal cadre of optometrists who recommend your lenses, your products, that gives you a significant moat or competitive advantage. This can happen across a lot of those sorts of industries with middlemen, plumbing, housing fixtures, and so on. But so we go through and identify through microeconomic analysis and then particular company analysis, the kinds of competitive advantages that people listening will recognize. And then we demonstrate through, we do 25 different case studies in that book of mostly European-based international global all-stars that people will recognize, Diageo, Hermes, and many others. And so the conclusion, the idea, trying to finally answer your question about quality investing, is that it's not highly likely that you'll be able to get Hermes on sale or L'Oreal, to take another one, Diageo. But if you've done the homework and identified a company highly likely through competitive advantages to be able to maintain high returns on invested capital over the foreseeable future and beyond, you don't need to get it on sale. You don't want to massively overpay into a euphoric market, but a slightly elevated price shouldn't be a deterrent. That's the main thesis of that book.
And I want to stick on this for a minute because you talk a lot about quality investments, quality shareholders. It's a pretty important word, I think, in your research and literature. And it's just interesting how hard it can be to define. So going back to Zen, that book, which is, the top philosophy book, top selling philosophy book, it really showcases how elusive it can be as a word. And Phaedrus, the protagonist, as you mentioned in your quality book, you quote him saying, "It's hard to define, but you know what it is when you see it." My takeaway from that book was sort of like quality is getting at least what you put into something out of it and then some, right? as he's tinkering with his motorcycle, he's getting more out of that machine. I'm just curious, is that beyond predictable cash, beyond high returns on capital and attractive growth companies, which is how you define it in a bullet point fashion in the book? Is there anything philosophically important or something that's, I guess, even beyond that for you when it comes to the term quality itself?
You're right about those points and the elusiveness and so on. But I think I'd say the key and unifying feature of that notion that you do know when you see that it's almost never accidental. And certainly if we're talking about quality of things that human beings create, diamond high quality, and humans didn't have any accident geology and so on. But if you're talking about a company or a firm of investors to achieve that kind of status, to be recognized and worthy of calling high quality, is the result of conscious effort and deliberate concentration and cultivation. And so why is there a high quality company? It is because for years they have devoted themselves to delivering an extremely appealing product with excellent materials, the finest craftsmanship, with deliberate efforts to restrict supply and to cultivate a clientele that pay up for what they're selling. So this is a process through which they deliver high quality products, and they deliver it with very high margins as a result. So these luxury shoppers are willing to pay up for their products, and that's a quality business model. And it's the result of deliberate, conscious effort, usually over a long period of time. And so the same would be true for those other companies that we describe in the book. And so we can talk soon about the other side. This is about a quality business. The other side is about a quality shareholder. What makes for high quality shareholder? It's also going to be the product of a deliberate and conscious and very reflective mental engagement. And so that's maybe the philosophical version of my use of the term in both of those settings.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.